Charles Biederman, last year around this time, you launched the Trim Tabs Float Shrink ETF, ticker TTFS. It's outperformed the Russell 3000 and the S&P 500 over the past year. What's driving it?
Well, float shrink is what's driving it. Companies that are buying back their shares and increasing cash flow outperform. That was the model that we started with, and the results have proven the model correct.
And why is float shrink a better way to increase share price as opposed to paying dividends? Don't people like cash back?
Yes, they do, and huge amounts of money have gone into dividend ETFs. However, dividend ETFs are underperforming the market and have underperformed the market despite the great PR they get. And so float shrink happens to not only outperform the market, but significantly outperform dividend ETFs. There's two ways companies can return cash to shareholders. The obvious way is a dividend. But dividends are taxable. 2/3 of all shares are held in tax-paying accounts, and so you have to deduct the tax. And then even if not including the taxes, float companies that shrink the float historically outperform.
So if dividend taxes go up, as a lot of people expect them to, if President Obama wins the election, do you expect more float shrink?
Well, there already has been. The dividend payout ratio is about 34% right now. Historically, it's been well over 50%. So companies have been paying less dividends and increasing float shrink. The other point to remember is top executives at companies make more money if the stock goes up than they do from salaries. So they're much more interested in a higher stock price, and particularly those executives who have options. Because if a dividend is paid, the option gets, you don't benefit if you have an option. So they're doing more float shrink because it works.
So finally, what makes your fund different from the other buyback funds out there? Because there are a few out there.
Well, the buyback funds don't count share sales. They just count buybacks. And we look at not only companies have to be shrinking the float, but they have to be shrinking the float using free cash flow and not borrowing to buy. We're not interested in companies that are doing equity leverage by borrowing, taking the money, and then buying back shares, because they could be the business could be deteriorating. We only want companies that are shrinking the float out of free cash flow. Our model portfolio, or not model, the actual portfolio, the average float shrink is 6%, and the cash flow yield versus market price is 10%. So companies are not only shrinking the float, but they're also adding to balance sheet cash at the same time while reducing the shares. It's a win-win, and that's why it's outperforming.